Hey everyone, welcome. Good to see you guys. Hope you guys had a wonderful day so far. Today we are mostly going to be continuing yesterday. So yesterday, the question I started answering was how do I develop a full trading plan? And if you did not or you weren't here yesterday and you didn't see that replay, then I highly suggest you go back and watch that. Otherwise, you're only getting half the story, okay? And you're getting some things out of order and out of context. So it's okay. You can watch live now, but make sure you go back and you catch yesterday's replay as well. That way, you get the full story of developing that trading plan. So we will take a quick look at the SPY, then we'll continue with that. Hey, Spider Monkey, great to see you. You move around quite a bit, don't you, Spider Monkey? You're really moving. Hey, James, Eduardo, Peter, great to see you guys. So I also got a question from someone asking about why in some of my programs, for example, the Gamma terminal, trading terminal, a lot of the recommendations tend to be the 70 delta or 65 to 75 delta. And the question was, so doesn't that make it a poor reward risk ratio? Am I not risking a whole bunch just to make a little bit? So I'll answer that question. That actually falls perfectly into trade execution. So we'll explain that thoroughly as we get into more detail about execution. So before I do that though, let's take a quick look at the SPY. It has now started to pull back. Yesterday or last week, all last week, I was saying, oh, it's about time. We need a pullback. We need a pullback. We're finally getting it. Today, we did cross below that EMA 8. Just barely. We ended up closing at 661.10, that EMA 8 at 661.18. Post-market, we are above it. So we'll see. Who knows what tomorrow will bring. But I still feel like, down to EMA 8, it's not quite enough. I do feel like we should be getting to near that EMA 20 or right around that EMA 20 before at this time around. And so I just be cautious. Right now, it's not the time to enter into the market unless you see a definitive bounce off of the EMA 8. And generally, I want to see it close above that EMA 8. So tomorrow at the open, if it's above the EMA 8, I personally am not going to get too excited. I want to see it above that EMA 8, and actually I want to see above today's high. Okay, so basically today's open is pretty much today's high, but I would love to see it close above today's high if I was going to start being okay with entering bullish positions again. So anything that we go through today, if we end up with an example, just keep that in mind. I'm not saying now is the great, today's, the first topic is going to be timing, right? Yesterday, the last topic was timing. So was it great timing? And the answer is not yet, not yet. Okay, so if we come up with an example, don't go rush off and trade it, and just know that now is not the perfect timing. It's not the best timing. Okay, so just a quick review, 4 parts to a trade. You have your trade idea, you have your timing, you have your execution, and we have our management. Okay? And most people, they really forget about this. And they confuse the timing for the trade idea. And then they'll focus a whole bunch on their execution. And then they may or may not come up with their management. And even if they come up with their management, they tend not to follow it. So that's where most people get into trouble when they are trading. So when I first got to Wall Street, I heard a lot about execution. And it was like, oh, you got to get good execution. You got to get perfect entry. You got to have a perfect exit. That's what a lot of traders talked execution. There's a very good book that I highly recommend called The Art of Execution. And so to me, when I first started, there seemed to be a lot of emphasis on execution, But what I noticed is that I don't know why, but that's what they like to talk about. But when they actually went and they traded, it was not all about execution. It was actually all about the other stuff. It wasn't really so much about execution. So we want to be very careful because execution gets very glamorized and it's easy to get focused in on the execution. Here's what I will tell you. A great trading idea and timing will save you from poor execution. And great management will save you from poor execution. Okay? Excellent execution will not save you from poor management. Excellent execution will probably not save you from poor timing. And excellent execution will not save you from a poor trade idea. Okay? But the other things can make up for bad execution. An excellent trade idea can make up for bad timing and bad execution. And to a certain extent, bad management. There's really no really good recovery from bad management. Okay, because if things go well and they go your way, then fine. Then everyone forgets about management. It doesn't really matter because if you go into something and goes straight up, you're good, right? But it's when things don't go straight up to your target, which is 99% of the time, that's where you can start to get into trouble. And if you don't have good management, then your mind psychologically will start playing games with you. Because yesterday, what I shared was that most of us are not wired. And I would say nobody is wired for success in trading naturally, because we're all wired for survival. And survival in the real world is not the same as survival inside the markets. And so we will get messed up if we don't have proper management. So execution, though, we already went through thoroughly the trade idea and timing yesterday. And so let's go over execution. Hey, John, good to see you. Okay, so let's find an example. Let me just say, I'll pull up maybe a Maverick. Maverick scan. And remember, this is somewhat backwards, okay, because remember, we would develop the trade idea, then we would look for a scan and the timing. So just know, I'm just doing this as a shortcut, okay? So just know that's not, just pretend we already looked at the markets, we looked at the bonds, we looked at everything else, and we got the context, we looked at our sectors and all of this. And then I'm going to look for a Maverick long entry. And I'll just pick one. Let's just say Ulta, okay? ULTA. Hi, Lise, good to see you. So just say for whatever reason, I like Ulta. Okay, that's not, let me actually pick something I might actually like. Okay, it's too painful for me to just actually try to do something that doesn't actually look good. Let's try Walmart. Okay, we looked at Walmart a couple of days ago. I said, well, I wouldn't necessarily trade Walmart unless it got above this line right here, or we got a definitive bounce off of the EMA 20 and above this line right here because of consumer staples. So I guess Walmart is not a great example either. Aflac. Okay, Aflac's not too bad. Well, A-Desk, AutoZone. Okay, we'll do A-Desk. Okay, we'll just do ADSK. Okay, and just for real fast, my trade idea is that we are net still bullish in the markets. Yes, we're having pullback in the markets, but Autodesk is still at all-time highs, even though the market has been pulling back. It's been showing this wedging pattern, this is ascending triangle. It's strong relative to the markets. It is challenging this all-time high right here. If it can break out, then it can probably run. And once we get that pullback from markets and it bounces, then Autodesk should be able to run quite well as well. So if all it does is go flat while the market is going down, and then the market bounces, then Autodesk is showing relative strength and it should go upwards. It's also on my Maverick scan and all of that, all the fundamental reasons why that would be a good idea. All that goes into my trade idea. The timing is now. Why? Because the technicals are telling me so, or my Maverick scanner told me so. And so now I'm at execution. Okay, so we are, people are saying RTX and GM. RTX looks very similar, and this is a defense, and so it's not necessarily going to follow the overall market. So that's a good example as well. And then we also have GM. GM is also looking very similar. You guys are, the only thing is maybe earnings, that's about a month away. That's probably okay. Okay, so out of all those three, I'll go with RTX. Why? Because this is a very clear, clean uptrend. Nothing to the left. We are near or at all-time highs, whereas both GM and ADS were at or challenging this level. So we could take those two on a breakout, but RTX is already trending. Okay, so I do like RTX, and it's just that the timing on RTX isn't excellent unless I'm trading a breakout. So yesterday we talked about why we trade breakouts or why we trade pullbacks, and that's because they offer us the best reward risk ratios. So if my premise right here is trading a breakout, and just say right now I would be a little bit early, but let's just do it. Okay, so how would I trade this as a breakout? So now this is execution. This is where we get into execution and management at the same time. So execution technically is, how am I going to express this idea that I should be bullish RTX? Am I going to buy the stock? Am I going to buy a bond? Am I going to RTX corporate bond? Am I going to buy a call? Am I going to do a call debit spread? And am I going to do a put credit spread? Am I going to do a butterfly? Am I going to do an iron condor? Am I going to do a calendar? How is it that I'm going to express the fact that I'm bullish on RTX? Now, in order to answer that question, I am going to also answer many of the questions that I would need to answer on the management side as well. Because these two, you can't really completely separate them. So, because in order to know my execution, I have to know my expectations. Am I expecting to be in this trade for a long time? Am I expecting to be in it for a week or two? Am I expecting to be able to hit a target very quickly? How far away is that target? I need to answer all those questions in order to know what my ideal execution is going to be. So for now, I'm going to remove spreads and any sort of spread from the realm of possibility. Let's just say I'm not super sophisticated yet. It's a little too complicated for me, and I don't want to think about that. So I just want to go into the equity, or I want to go into a simple call or put. And maybe I don't even want to go into equity. I know I want to do an option. I'm limiting myself in that way, but that's okay. I have to go with what I know, what I'm comfortable with, until I educate myself in the other areas. So let's just say that's the realm of my education. I'm going to do a simple call or simple put. Since we're bullish, then I'm going to do a simple call. Okay. Now I have to form an opinion as to why I'm bullish. That includes all of the background stuff in the trade idea. And I need to know how bullish. And every person is going to be slightly different here in terms of how bullish they are. I also want to know, what's my time frame? Do I want to be in this for the rest of the year? Do I want to be in this for 1 or 2 years, or maybe even longer? Do I want to be in it for a day, for 5 days, for a couple weeks, for a month? Maybe I want to get out by earnings. Maybe I don't want to hold through earnings. I don't like that volatility. Okay, so I need to know the time frame. That time frame will help me determine my target. And sometimes I pick my target and that helps me pick my time frame. Each trader is going to approach how they answer these questions differently. For a beginner, probably the best thing that you can do is to take a risk-first approach. Okay, so that's what I'm going to show you, and that's what I'm going to teach you guys. Take a risk-first approach, and then you can, as you get more sophisticated, you can take other approaches first, but this is always appropriate. A risk-first approach is always going to be appropriate. And that's actually how professional portfolio managers and traders, they tend not to be risk first. And that's why we have things called risk committees. And they kind of look over your shoulder and say, hey, no, don't do that. No, you can't do that. Okay. And then the trader gets pissed off and like, why not? And then you have this fight between the risk managers who tell you what you can't do and traders who want to do what they want to do. But the risk managers are there for a reason, so you don't get ahead of yourself. Now, as retail traders, we don't have risk managers. We don't have risk committees. We don't have those people looking over our shoulder. So we have to get really good ourselves at managing risk. And that's another reason why I say for a beginner, just get used to just looking at the risk first. You start with the risk. So the first thing that I look at and say, okay, assume I'm going to enter tomorrow. I think it's going to break out. It needs to break above basically exactly where we are right now. So just say, I want to enter at 161.50. We closed at 161.38. Post market, it says 161.71. I don't really care too much about the post market. I want to enter at 161.50. And tomorrow, if we're already well above that, then too bad. I missed my entry. Okay, because I'm looking at this after markets. I'm not looking at it intraday. So I missed my entry. That's fine. Maybe it pulls back to 161.50 and then I enter. That's fine as well. But I have to decide where I'm going to enter. And it's not like most people, when they say, oh, scan, go, jump in and go. Well, that's not where you're going to get your best timing. I explained that yesterday, where I said you could go down to an intraday time frame, look at the VWAP, and then make your entry from there. But let's just say we've already decided that we're going to enter at 161.50 tomorrow. Okay, that would confirm, or at least right now, for now, that confirms a breakout. I would want a close above that, or I would watch intraday and see that it stays bullish throughout the day before I entered. But that's really just fine tuning. If I enter here, it's a little difficult because where do I put my stop loss? And a lot of people will say, well, you stop at the EMA 8, EMA 20, EMA 50. If we do any of those, it's even that EMA 8 is kind of far away. Okay, so if I did that, that is 2.6 away. Well, actually, that's not bad. And why do I say that's not bad? Because my ATR right here is 2.43. Okay, so generally, I would like to have risk around or slightly larger than 1 ATR, because 1 ATR represents random movement. And normally we don't expect to go in a single direction an entire ATR in just one day. Usually it takes 2 or 3 days for me to travel 1 ATR, close to close. Intraday, it might swing past that, but close to close, I'm not expecting it to travel that far on a single day unless the movement is non-random. Okay, so basically, I don't want to get stopped out just because of randomness. I want to get stopped out because I was wrong about which way RTX was going. So that's what I'll do. I'll set my stop first, or we call them stops, but really it's how do I decide when I'm wrong and it's no longer worth being in the trade? I have to define that level. So once I have that defined, then I've got to say, I should, at a beginning level, I should always be looking for bare minimum 1-to-1 reward risk ratios. And if you really are a beginner, I would recommend at least a 1.5 to 1, if not 2-to-1 reward risk ratio. When you get better and you're better at managing yourself mostly, but also your portfolio and your risk, you can consider 1-to-1 or less if you have a win rate that justifies that. But most people, even after several years of training, they do not truly understand win rates. And even if they understand win rates, they're not consistent enough to really execute on win rates. Okay, what do I mean by that? What I mean by that is, this is an alert system built on my Maverick indicator. And it is a very precise system. When certain conditions happen, this system says you enter. And when other set of conditions happen, the system says you exit. And so if I do the exact same, those parameters never change. So if I'm always entering on the exact same set of parameters and I'm always exiting on the exact same parameters, then I am consistent. What might happen is that we get a signal and then the system says exit at a loss right here. And I go, oh, that's so close to the EMA 8. It's just 20 cents away from the EMA 8. It might go down and just bounce from the EMA 8. Why don't I just hang on to the EMA 8 or see if it'll bounce from there? Great, I've just changed the system. I cannot rely on the numbers, on the win rate that the Maverick system tells me I should have. And if I do that over several trades, I've completely messed up all the stats of that system. So most people are not disciplined enough to stick precisely to a system. And that's why I say that win rates can be a little deceptive, especially if you don't have several years under your belt and learning to control yourself and your emotions and your impulses, that your survival impulses that don't work in the market but work to keep you alive in the real world. Well, then you can't rely on those win rates. So if my Maverick system says, hey, you got a 80% win rate, therefore you can afford to go, a 0.8 to 1 reward risk ratio or 0.575 to 1 reward risk ratio, because you'll still come up, your still expectancy over 100 trades or 1,000 trades is still net positive. But then you start mucking around and you don't follow those signals exactly, then you can't expect that 80% win rate anymore. And it could be wildly different, okay? So most people are, number one, they're not consistent enough in their behavior, in their psychology. But number two, we're not perfect no matter what. Even if our psychology is iron tight, well, if the Maverick system says enter, doesn't mean I'm going to enter that very second, right? And the Maverick system says exit, doesn't mean I'm going to exit that very second. It's going to take me a few minutes, or maybe even I might not even notice for half an hour or 2 hours, and like, oh, I should exit. Okay, so that's going to mess up the stats as well. And so at the beginning, we never rely on, say, hey, I've got a system that wins 75 or 80% of the time. I can afford to go below 1-to-1 risk ratio. No. At the beginning, always bare minimum, since we're assuming that you're all basically at the beginning, bare minimum 1.5-to-1 reward risk ratio. That way, even if you are only hitting at a 50% win rate, you still have a very high expectancy. You can still be very profitable. Okay. So I'm going to start with my risk in the trade. I want my risk in the trade to be at least 1 ATR, generally, not too much higher than 1 ATR usually. Okay, but at least 1 ATR. And then I can set my target from there, at least 1.5 ATR away. Now, if I was doing something else, like just say we were doing a bounce, okay, bounce off of the EMA 8, right? So on the 18th, it bounced off the EMA 8. On the 19th, it confirmed that bounce, even though it's a red bar. The entire body of the red bar is above the high of this bar right here, the bouncing bar. So it technically bounced off of both the EMA 8 and the EMA 20. And so if I want to enter here, and we say, well, 1 ATR is 2.45 away, and that puts me basically at the MA 50, I could do that. But if I want to risk less in my trade, I'm also safer than otherwise if I move this and just say, hey, I'm just, if we go below that EMA 20 and we go past the low of the bouncing bar, I'm good. I don't have to wait all the way to the MA 50 and I'm done. And so I can risk less. And that makes it easier either for me now for a 1.5-to-1 reward risk ratio trade. Now it only has to go up to here, to much less, okay? And so generally, so this is to basically only has to move 1 ATR to hit my target, since I chose this to be less. And then we could be like, well, Kane, if I'm doing that, then I'm risking being taken out by randomness. And that's true. But I'm also counting on a bounce being non-random directional movement upwards and not downwards. So if it really was a bounce, it would just go up. It wouldn't kind of flutter out, unless you had a really, what was a really wicky monster? Not super wick, yeah, but yeah, see how these big wicks downwards, shadows, I guess. Okay, down and way back up, down and way back up. There's many of them, or up and way back down. That is a highly volatile stock that doesn't trend super beautifully. So that you can make an argument that, okay, for sure on a stock like that, I don't want to be taken out by randomness. And so we would set the ATR, or set it at least 1 ATR. Okay, but for RTX, it's not like that. And so you could set a smaller than 1 ATR. And in any case, we're also going by the close, right? If it looks like we're going to close outside of our stop zone, then we'll close it out. If it's just an intraday kind of tag or goes out and then comes back in, I'm not going to worry about that. I'm not going to stop myself out because of that. Okay. So everyone following so far, let's see. Hey, Frank. Hey, Kay. Hey, Raj. I'm answering your question very thoroughly on coming up with a trading plan. So we already went over the market at the very beginning for a couple minutes. Okay. Hi, JB. So once I've decided, well, we're doing this as of today. So once I've decided my entries, oops, that was at 161.5. Okay, I determine my exit, my stop, and I determine my target. Okay. The next thing I'm going to do is I'm going to say, is there any reason to believe that I can't hit that target? Because what if, I mean, I could set my target anywhere, right? I could just say, is there any reason for me to believe that it's not going to go to 180? And the answer is yeah. There's a lot of, that's really far from where we are right now. There could be a lot of reasons why we don't go straight to 180. But if I set something reasonable, like I do a 2-to-1 reward risk ratio, then I ask myself, is there any reason to believe that it can't go straight there? Or, so part of that answer is going to be how many ATRs are we? Well, if this was 1 ATR, then that's roughly 2 ATRs. Okay. And normally, does a stock move straight to ATRs? No, it's not going to go straight. It could go up and sideways a little bit and then up, get a hit a level, pull back, and then go up. Okay. But in general, so 2 ATRs, let's say, just say 5, and the ATRs are going to be slightly different over here, but it doesn't matter. We'll just take a rough estimate and say, how long did it take for it to do 5 right there? Okay, so it went 1 and then sideways for 3 days, and then it made it to 5 on that 5th day, I guess, if we count the day that we enter as a day. Okay, same with over here. Over here, that was able to do it in just 2 days. And then if I entered on this bar at the open, then it takes a little longer. This one took about 2 weeks. Okay, if I entered here. Okay. So just so we have mental preparation of how long it might take for us to get to a target. And is there an important level? In this case, there's not, because we chose one that was at all-time highs. But are there levels in between, important resistance levels, that might get hit and might delay that movement upwards? And so even if something's at all-time highs, at the very least, I can check gamma. Oh, okay. Good to know, Raj. Good. Okay. So on my way to that 166.8, is there anything in the way? And there's probably going to be 165. Okay, so there's right there, 165. The next, other than the support below us at 160, the next largest gamma is right there at 165. There's a reasonable amount at 162.5 as well. So I'm going to throw those on there. Oops. Just so I know. Okay. Now 162.5 was already exceeded and then retreated from that today. So I'm not going to care too much about that. Okay, and especially since I'm entering pretty close to that level. And so my belief, for whatever reason, my trade idea and my timing was that now is a good time. And so I'm not going to worry about a super close gamma pocket. That 165 though, it could prove to be resistance, and we could chop sideways from there or pull back from there. And so I have to decide, do I want to sit through that? Okay. If I want to sit through it and get all the way to 166.8, then that I have to keep that in mind when I'm selecting my option and my expiration. Or I can say, hey, 165 versus 166.82 doesn't seem like it's that far off. Maybe if I'm going to hit resistance right here, then maybe I'll just move my target right there. And I will check and see if that's a reasonable target. Okay, so if we move this to 165, okay, that becomes a 1.33 to 1 reward risk ratio. Not quite the 1.5 I said that at the beginning you should probably be looking for. But, you know, it's better than 1, it's better than 1.25. And I might be okay with that, okay? Like for me, for sure, I would be okay with it. For a beginner, right, who's learning to manage their risk and look for reward risk ratios, then I would say, no, just keep it where it was, because I don't want you to get in the habit of adjusting yourself down and changing things too much. At the beginning, you want to develop the muscle, and then later on, you can adjust things as needed. If that was 1.5, I'd say, okay, just target 165. And at 165, you know, that is 3.5, it's like 1.5 ATRs, not even 1.5 ATRs, about 1.3 ATRs away. And that could happen in like a week, like 4 or 5 trading days. And so we could pick a very short dated option and pick something really fast, but we're not going to do that. Okay, we're going to keep it like this. We're going to target that 2 to 1 reward risk ratio. And I guess 2 to 1, 2 to 1. It doesn't have to be like super precise, but we'll get there, okay? So now that I know this, now I have put my risk first. I'm basing my target on my risk. I've considered randomness in my risk. I've considered levels in which might interfere with me getting to my target. And if you want to, you can throw support levels right there also, but support levels just make your trade even stronger. Less likely that I will move through my stop loss. Or if you had an important support just below where you defined your stop loss, then I would consider moving that stop loss below that level also. And then you would have to adjust your reward if it made sense as well. Okay, but we're doing this for now. And so I need to know my expectation of how long that this could take. So am I super bullish on RTX? Because it's going to break out, it's going to run. I think it's going to hit that target in 2 days. Okay, by the end of the week on Friday. Okay, or do I think, hey, it's going to go pretty much at the pace that it's been going up, and maybe I'll hit some resistance and go sideways for a couple days, and then I'll go up at that same pace. Okay, so then maybe I would need 3, 4, 5, 6, 7, 8, 9, or 10 trading days in order to get to my target. Okay. To be conservative, I would assume that it's going to take longer than shorter. Unless I have a really great reason to believe that I should be hyper bullish on RTX, then I should give it more time, right? I should think that it's going to take longer rather than shorter. So I'm going to say, I believe that it could do it in 10 trading days. Okay, so that would be that. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yeah, okay. So if I believe it can hit it there, give myself a little bit of wiggle room and say maybe we'll go up to the Friday instead of Thursday. So that's my time frame. If it goes slower than that, I probably want to close the trade because I'm talking about buying an option. And if it takes longer than I think it's going to, then I'm not going to make nearly as much money, or I could start losing money because of time decay. So I really need to consider this fairly carefully. Okay. So if it goes slower, then I want to be out on this day anyways, even though it didn't hit my target or it didn't hit my stop. If it just kind of does this. Okay. Because I'm trading the option, I still want to get out. If I was trading the equity, I might be okay with hanging on. Just like, you know what? I'm not going to get out until it hits my target, even if it takes 2 months or 3 months, because it really starts chopping around over here. You could, but then we would have a question of the efficiency of your money. Like, would your money be better served if you took it out and put it in a trade that could reach its target faster? Okay. But since we're talking about options here, you definitely want to define that time stop, because you're losing time value. You're losing on time decay the longer it takes for it to reach that target. So no matter what, if it hasn't gotten to the target or gotten to the stop by the expiration date, whether it's right somewhere in between, close the trade at a less than expected profit or a less than expected loss, okay? Which is fine. That's perfectly okay. Okay, so we have that time stop defined now of October 10th. Okay. So essentially what has happened is that I pretty much came up with my management before I even finished coming up with my execution. And that's normal in options trades. Not necessarily normal in other types of trades, but it is normal in options trades. Okay. So now I've got basically all the pieces I need in order to start considering my execution. ATR is a 1-day range. ATR is the average of the last however many bars, I use 10, from close to high or low the next day, averaged over the last 10 days. Okay. So it is a measure of the close to an extreme on the next day. And so that is generally what we would consider a non-random 1-day range over the last 10 days. So yeah, it would be a 1-day move that it measures. Okay. Any questions so far? Are we following along? I tried to go fairly slowly and very clearly so that it would be easily understood. Okay, so I'm not seeing any questions, so I'm going to assume we're good. And I don't know how big the delay is. Sometimes the delay is huge. So, okay. So I'm going to move on since I'm not seeing any questions. So now I need execution. To answer the question of execution, now I need to consider what type of risk tolerance do I have as a trader? Okay. So do I like big swings? Do I like 100% wins and 100% losers? Or does that make me too nervous, and would I rather have 30% wins and 30% losers, or 30% wins and 15% losers, right? The size of the loss, okay? So we need to take that preference into account. Do I want to make the most out of every trade, understanding that I'm going to lose more trades? Or do I want to win more trades at smaller amounts? Those are you have to answer that yourself. Okay. So here's what I'll try to find a happy medium. This should work for most people, unless you're just degenerate. I have to have 300% winners. I have to make 2x my money every single time. So here's the general rule. If we're looking at single options, if we look at a profit curve, I don't have a drawing pad. Do I have my G ink? Okay. Oh, it won't run. Okay. I'm going to do my best to describe this in words and maybe draw. This never works out for me when I try to draw using this. Maybe I can draw on here. Okay. This will probably work a little bit better. Okay. If we look at profit, so per $1 or per 1% move, okay? So as the underlying stock goes up, how much profit do I get off of my option? Okay. I should get my draw pad out. The curve is like this when we look at our deltas. And so the most efficient range of basically option prices increasing with the movement of the stock, the most efficient range is a delta of 40 to 70. And, 70, 75, okay? 40 obviously is going to make money faster than 70, but 70 is going to be more conservative and more risk tolerant than 40. But it's pretty fast. You get pretty rapid growth in that 40 to 70 range. And so if we're looking at RTX, just say October 17th. Okay, let's actually do this properly. I expect to hold this to October 10th. Okay. So now my question is, what expiration? And all of these topics kind of bleed into each other. So I'll give you the considerations, and then we'll pick a happy average. To make my life simple, I could just use October 10th as the expiration, since RTX has weekly options. If it didn't have weekly options, obviously I would have to do the monthly option. My only choice would be either October 17th or November 21st. I would pick October 17th because it's much closer to my expected hold date, and I'd be buying too much time value on November 1st. Maybe, okay? For sure, I'd be buying too much time value if I was buying January. So basically, I would have to choose between October 17th and November 21st. And if those are my only two choices, then that makes my life a little bit easier, because what I can say is, well, I only have these two choices. This one is kind of close. It's only 1 week after my planned hold date. Great. If that's so, I need to be more conservative in my strike selection. So I need to be a more conservative delta, and therefore I should be pushing more towards the 70 delta range than I should towards the 40 delta range. And then if I say November, well, I have leeway. Okay, I have plenty of extra time because I'm not going to hold this thing anywhere near expiration. And so I can probably afford to go down to a lower delta, 40 to 50, for example, if I choose November 21st. Okay. But since I have so many expirations that every week there's an expiration on RTX, I don't have to do it that way. I say, hey, if I match the expiration perfectly, then I should always be in the money and I should be pretty far in the money. Okay. And the reason is because the true cost of your option is not the price that you pay. It is the extrinsic value that you pay. Why? Because as of right now, with RTX at 161, just in the intrinsic value, just of any one of these options that are 160 and below, I've got some built-in value right there. So on 160, I have the right to buy at 160. Okay? If I have the right to buy at 160, then I could sell it to the market at 161.38. That means there's immediately $1.38 in value. So the first $1.38 that I pay for this contract is just pure value. It's pure, it's, how do I say it? I'm actually getting something for it. The value is there. I'm getting that money back in something of equal value, okay? What I'm paying extra, or the premium that I'm paying on top of it, is only the extrinsic value. Okay. If I go out of the money, then it's all extrinsic value. I'm not getting anything back from my money. So basically, this option is costing me right here about $2.70. And I get a worthless piece of paper for it. It's not worth anything by itself. Okay, there is a market value that I can trade it at, but intrinsically, inherently, it's not worth anything yet. If I go right here, I pay $4, but immediately I get $1.38 of that back in value. I have a piece of paper that is already worth $1.38. Okay, so I'm actually paying $2.70 about in extrinsic value. Okay, and so actually they have the same, pretty much the same extrinsic value. Okay. If I'm going to buy this exact expiration and I plan to hold to expiration, if the price goes nowhere, all of these are going to go to zero. Why? Because all of your extrinsic value is going to disappear. And so basically, that's true for any of these. All of the extrinsic value is going to disappear. And out the money, that means I lose 100%. And the further in the money I go generally, it means the less I'm going to lose. So here I'll lose $2.67, here I'll lose $1.80, here $1.20, here 92 cents, here 45 cents, 45, 27, 22, 32. And you can see it bounce around a little bit because those are wider bid-ask spreads. And so it does bounce around a little bit because this assumes you get in right at the midpoint. Okay, so we have to keep that in mind as well because you probably won't, or you won't want to. You won't. Ideally, you get better than the midpoint. Okay, so this thing is super cheap. It's only 22 cents in extrinsic value. If I pay $14.60, 65 cents for this, I get something that is worth $14.40. I'm only paying 22 cents extra on top of it. Whereas this, I'm getting something that's worth absolutely zero, but I'm paying $2.70 for it. So here I'm paying $2.70 above the intrinsic value, and here I'm only paying 22 cents above the extrinsic value. Okay. So because I'm going to hold to expiration, I know that all of the extrinsic value is going to disappear. So I want to buy something that has very little extrinsic value. And that's why I say, if you go right at expiration, right to your hold time, you want to go further in the money where these extrinsic values are very low. Okay, the more time I buy myself versus my expected hold time, the further I can go out the money. Okay, so if I buy myself a week of extra time, I don't have to go so far down, because by the time I exit, there's still going to be some extrinsic value left. There's still going to be some time value left. I have a week before expiration. If I go all the way up to November, by the time I exit, there's going to be a lot of time value left. There's going to be a lot of extrinsic value. So I can afford to go further out in the money. And if I go really far, if I buy a leap out to December 26th for whatever reason, I don't know why I would do that, and I'm only going to hold it to October 10th, right? Then I'm going to lose almost nothing due to extrinsic value. It's be kind of pointless. Okay. So at that point in time, the price is going to be very insensitive. Okay, and basically your delta is the same, but the cost of your option is so high that delta represents a very low percentage of your cost. Okay. Any questions so far? Making sense? EQT, I can take a look at EQT. Yeah, Tim. So far I haven't even, so I guess we pretty much covered management. I'll have more to comment on management, I guess, tomorrow. But right now I'm trying to get through this execution and the expiration dates. So the closer to expiration my planned hold time is, the more in the money I want to be, because I want to preserve as much extrinsic, because extrinsic value goes to zero at expiration. So I'm going to lose all of this unless my stock moves so much that it now becomes in the money, right? That if I was holding something I was out of the money and it became in the money. And that's what I meant by efficiency of deltas, because that 40 delta, I don't even have 40, there's a 35 delta, but that 40 delta will become the 50 delta at the money. And then it'll become a 70 and 80 delta the further in the money it goes. So it's as the market goes up. Okay. For a leap, you can sell the call and it will get good extrinsic value. If you sell an out of the money call, you'll get good extrinsic value, yeah. But if you close it nowhere near expiration, again, you're not going to get a very large percentage gain. Okay, so you're going to become a lot less price sensitive. So the closer you are to expiration, the more sensitive everything becomes, right? So the delta, the gamma, the time decay, all of that is heightened the closer you get to expiration. And the delta becomes a representative of a higher percentage of the price, okay? So if I'm just only looking at 50 deltas and I go all the way out to here, 50 cents on $25 is like, what is that, like 2%? Can't do my math right now. Okay, 0.5 divided by 25. Yeah, 2%. Okay. But if I go over here to the monthly expiration, 50 cents on $3.50 is 0.7, right? 7, no, not right. So 14%, okay? Represents a much larger move. So a $1 move in the underlying moves this one 14%, whereas it moved that one way out there only 2%. Okay, so if you sell super far expirations, you're not going to make a lot of money on that movement. Okay. You can trade 70 delta with less time. Yeah, you can go further in the money. The less time you give yourself, the further in the money I would go. Yes, absolutely. Okay. And one good rule of thumb is if you're going to go right on expiration, like if I said, I plan to hold this thing to October 10th, which one should I do? I wouldn't even bother with 70 delta. Okay, what I would do is I want to say, I want my extrinsic value to represent no more than 1% movement of the underlying. Okay, so if I take this 1% of RTX, that's $1.61. I want an extrinsic value that is less than $1.61. So that means I'm going to go to 155 or lower strike, which happens to be 79 delta, so about 80 delta and higher delta or lower strikes. And the reason is that means if RTX moves up just 1% by the time expiration rolls along, I will have at least broken even. If I do this one, $1.19, and it moves up $1.40, $1.60, then I will have made 40 cents. Okay. And a 1% move on something I'm really bullish on shouldn't be a large ask. I should be doing this on a stock that I believe can move 1% very easily. And one ATR is well above 1%, right? It's 2.43 versus 1.61, okay? So it's like 1.5%. One ATR is already 1.5%, okay? See how all of those things fit together, all those concepts fit together, the ATR, the percent movement, and my extrinsic value. Okay? So if this thing moves, basically my extrinsic value is how much my underlying has to move by expiration in order for me just to break even. So if I pick the 162.5, it's got to move $2.70 just for me to make zero. And so it's got to move even more than that in order for me to make money. This is at expiration, okay? So I need, if I'm going to choose a very short expiration or that matches perfectly with my planned hold time, then I want it to make it very easy for me to break even, because then, which also means that it's going to make it very easy for me to make money. Okay, so I go for break even because that's the risk management side of me, right? I will always want to consider my risk first, make it easy for me to break even. Anything on top of that is gravy. It's money, it's profits. But I need to take care of the break even point first. Okay, so this 22 and this 22. Well, guess what? If I get 222 like this, I'm going to go with the one that's further out of the money, or less in the money, I guess you would say, because extrinsically they cost me the same thing, but that percentage of the delta is bigger, or at least the delta relative to the price I pay is bigger. So each $1 move is a bigger percentage gain for me. Okay. Any questions about that? Is this making sense? Considerations that I have for how I pick my strikes and my expirations? And this is probably way more thorough than you've ever heard anyone talk about. Right. Let me know if you've heard anyone go even more detail than me, because I'd like to know, because If they have, then I'll go in even more detail at like every single last bit. But I mean, there's not much more detail than this that you could possibly want to know in choosing. If you're deep in the money, then your reward risk is far less than 1. No, that's okay. So that's the misconception. Okay. Okay. So, and that's pretty much the question that was asked of me yesterday. And I thought I was doing a job, but I did not explicitly talk about this. So for this to lose $14, like what has to happen for this to go to zero? RTX has to go below 147 in order for this option to go to zero. Okay. So RTX has to go to 147 for my 147 strike call to go to zero. And it's got to do it by October 10th. Okay. So it's got to do this. And the chances of that are not zero, but they're pretty close to zero. They're pretty low. Okay. So we can't think of it that way. If I want to do a 1-to-1 reward risk ratio, this is how I'll do it. Okay, watch this. We can get into this at about 14.6. Okay, 14.6. If I say on October 10th, since that's my planned hold time, what does it take to get the theoretical price down to zero? Well, I already told you, we got to go down 147. We've got to go down 14.38, okay? Okay, so 14.37, oops, minus. 14.37 still gives me 66 cents of value. Okay, so 14. Okay, probably I need to bump this up to the 11th. Okay, so and you can see that the theoretical pricing model is not perfect because it still gives me a tiny bit of value even though I'm past expiration. It shouldn't. Okay. Unless there's an aftermarket price that I'm not aware of, which could be. In any case, this is not what we're evaluating. And we're not, and you can't say that I'm risking the 1400 to make a tiny amount. Okay, so what we need to see is like, if I hit my stop, what was my stop? Oh, I got rid of it. Okay, my stop is 158.86. Okay. If I hit my stop, I am losing. Theoretically, it's at 1186. Okay, I'm losing $2.74. We'll call it 275. Yeah. So now I'll want to know how high does it have to go for me to make that same $2.75, because that would make it the 1-to-1 reward risk ratio. Okay. So $2 plus 14.65, 17.4. Okay. So I want this value to be 17, the theoretical value to be 17.4. Where is my, right here. Okay. So, and that's about it. That's pretty much it. So I would have to go up $3 or down to $2.75. So the same stop loss would be equivalent to okay. That is a 1-to-1 reward risk ratio on the option, on the 147, that 1% extrinsic value option. Okay. It is slightly worse than 1-to-1 on the equity, and we expect that because of time value and a few other things. It's not as efficient. So when you translate it into an option, and that's why I said always at least better than a 1.5-to-1, because you're going to lose a little bit, right? Notice that we only had to go down $2.52, but we had to go up $3 to get that 1-to-1 reward risk ratio on the trade. That's because of the time decay and because of the IBs. Okay, and it's always going to be like that. Now compare that to here. Okay, compare that to this, to the at the money. So if I go down $2.52, okay, then I've lost $2.7 minus 0.46. I've lost $2.24. Okay. Now, how much? $2.24. How far do I have to go up to make that same $2.24? So 224 plus 2.7. Okay, that's 494. So I need a theoretical value for this to go to 494. Okay. Okay, so you see that? In order to make this a 1-to-1 reward risk ratio trade, I would lose $2.52 on the downside. That would be my reward risk, or that would be my stop loss, right? But in order to make this a 1-to-1 reward risk ratio on the at the money, it has to go up $6.06. Okay. So if I do this, now I've got to do 606. I gotta be way up here. And that is on the equity, that's a 2.3-to-1 reward risk ratio. So going just to at the money made this really, really unfavorable, because just to get a 1-to-1 on the option, I've got to have a 2.3-to-1 on the underlying. That's really kind of unreasonable, right? So if I'm saying that I've got to more than double the performance to the upside just to make the reward the same as the loss on the option, that's really, really bad. Okay. And this is why, since we're looking at a short expiration, we want to go in the money. This effect is a lot less extreme if the further we go out in expiration. But the shorter expirations, this effect is really extreme. So here we are thinking that we had a great trade at a 2-to-1 reward risk ratio, but it turns out if we do it over and over and over and over again at a 50% win rate, we would lose money if we were just trading the at the money option. Okay. Is that eye-opening for you guys? So it's not true that you're risking a tiny bit to make, or you're risking a whole lot to make a tiny bit if you go in the money like this. In fact, that's what you're doing when you're going out of the money. And it's because here you have a whole bunch of extrinsic value that you're putting at risk. And over here, I'm only putting a tiny bit of extrinsic value at risk. I'm putting extrinsic value, the first 22 cents at risk, and then a little bit of intrinsic value. Here, I'm putting all extrinsic value at risk. Okay, let's see what you guys are saying. When you're monitoring your trade, do you look at portfolio delta, gamma, vega to decide your exits? I'll have to go over that tomorrow as part of the management. Saying understood. If you're deep in, very helpful, interesting, and no, great info. Have to watch it again. Normally take 40 to 60 days out and a 30 delta. I never go beyond 40 delta just because that's where the most efficient move is, even if I go 40 to 60 days out. The option pricing part is priceless. Okay, good. Informative, yes, great in-depth. Okay, excellent, good. Glad you guys are understanding. Glad we clear up some misconceptions. So these out of the monies, they're not cheaper. The out of the monies are good for very fast, extreme moves. That's where you're going to way outperform the in the money ones. But anything other than extremely fast, 1, 2, 3 day, very large move, right? Everything in the money is going to do a lot better. And for the risk, and when I say a lot better, I don't mean percentage gain. I mean your reward to risk. Right? Your reward to risk is going to be far better over here. The only place where that becomes kind of not true is potentially really far out of the money. And really far out of the money, you can get really great reward risk ratios also. However, your percentage win rate is extremely low. So you got to be okay with only winning like 10% or 20% of the time. So generally, I don't recommend, especially for beginners, I do not recommend something far out of the money. Okay, so you're in the vast majority of scenarios, and remember, I'm trying to give you guys a happy average here as beginners, because maybe you can't think about all these things all the time when you're trading. It's too much to consider and it would slow you down, and you're trying to get into the trade, but it takes you 3 hours to figure this out, and it's not very practical. So I'm trying to give you a happy average here, and that is the closer you are to expiration, or the closer you plan to hold your trade to it, the expiration that you choose, the further in the money that you want to go. And if you match them up perfectly, then you want to have no more than 1% of your extrinsic value represent no more than 1% of the current price of the underlying. And then as you space out, you give yourself more time between expiration and your planned hold time, you can start to go closer and closer to at the money. And so just remember that you're probably better served. And so I believe Roger always likes to give a 70 delta. And in my software, I always recommend a 65 to 75 delta, because I don't give a whole lot of time of expiration beyond what I think the hold time is going to be. Okay, and so you're probably better off, if you're going to use any general rule of thumb, it's going to be 65 to 75 delta or 70 delta. Okay, so all right. In this case, would I go for a debit spread or call buy? Well, so we made the assumption that it was a single option, but if the reason why I would do a debit spread versus a single call, well, number one, it's almost always favorable for me to do a debit spread, almost always. Again, the only place where it's not is where you have the really fast extreme moves in a single day, 1 or 2 or 3 days, very short time frame. Okay, but I'll go over that in either tomorrow or Friday. Okay. All right, guys. Hope you guys are enjoying it. Hope I'm still blowing your minds, opening your eyes to how these things work and all the considerations that we have. We'll end it there. I went way over time today, but hopefully you guys were interested and kept you guys engaged. Okay. Have a wonderful rest of your nights, and I will see you all tomorrow. All right. Bye, everyone.